What's up, everyone? My name is Ale. Welcome back to my world of stocks. Now, as you probably know, Warren Buffett was surprisingly a net seller of stocks during the 2020 stock market crash. But what you may not be aware of is that Saudi Arabia, on the other hand, was out on a shopping spree during the same time. So what we're going to do in today's video is we're going to run through the list of all the stocks that the Saudi Arabian Wealth Fund has purchased so far in 2020, and I'll be sharing my opinion on each one of them as we go through the list. But to keep the video from being overly long, I'll be doing a more detailed listing for the top 6 largest stocks in that portfolio, and then we'll do a much faster rapid fire for the remaining stocks on the list. Should be a fun video though, and I really hope you guys enjoyed. If you do, please consider hitting the like button. Really helps the channel survive and grow, and it means a lot to me. But with all that said, we got a lot to cover. So let's just start with a quick intro into what the Saudi Arabian Wealth Fund is, and then we'll go straight into all the different stocks that they've purchased here so far in 2020. Okay, so in case you've never heard of them, the fund is a large component of the country's Vision 2030 plan that looks to lower their dependence on oil, become a financial leader in the world, and further develop several other parts of the country's society and economy. And by the way, I'm sure most of you are well aware of all the different controversies facing the country and its leadership, but I just want to remind you guys that is not the focus of this channel or this video. We're just here interested in seeing what stocks they purchase, because this is a fund that is considered a global powerhouse that does hold a lot of influence over markets. In fact, they currently have over $300 billion of assets under management, and as part of their Vision 2030 plan, they're aiming to become the world's largest sovereign wealth fund with at least $2 trillion of assets by that 2030 year. Of course, in order to accomplish that, they will need to continue buying huge amounts of stocks and accelerate that buying during any market dips or crashes, which, as you guys know, the US market crashed at the start of this year by almost 40%, and the fund didn't hesitate to pounce on what they felt was a buying opportunity. In fact, their US stock portfolio grew from around $2 billion at the end of last year to a whopping nearly $10 billion as of the end of the first quarter this year. In other words, that portfolio grew by over 4 times the amount in just 1 quarter's worth of time, which is pretty crazy. Although previously, we should mention that they only own 2 stocks, which were Uber and Tesla, and they actually shrunk that Uber position while also selling out completely out of their Tesla position. So it was basically just them adding a huge amount of brand new stocks to that portfolio. But kicking things off here with the 6th largest, the first one of those is going to be BP. Ticker symbol is BP, at over $800 million invested and an estimated share price of around 24 bucks a share. But keep in mind that the share price is just an estimation by a financial research site called Fintel, and it could easily be much different than that because we don't know the exact date that a stock is purchased. Anyway, BP is obviously the oil and gas company that is unfortunately famous for their oil spill, their very large oil spill in the Gulf of Mexico, and they basically do it all when it comes to oil, from drilling to refining to even selling in gas stations. Now, the stock fell off a cliff this year as they are currently down almost 40% year to date and over 50% from their 2018 highs, which was obviously fueled by the global health issue destroying travel demand, as well as the Saudi-Russia oil price war that sent oil prices crashing by over 70% at one point. Now, we have at least been seeing a small rebound since then, and when prices are stable, BP has actually proven that they can generate decent profits on top of huge sales. But analysts are now expecting a revenue crash of over 20% this year, with profits falling by even more as their EPS plummets by an additional 84%. As a result, the forward P ratio is sky high right now, but even trailing, it still sits north of 20 according to Yahoo Finance. And even though their dividend is extremely attractive at over 11%, it's not exactly without risk, as even if they decide to continue paying it, that'll likely result in even more debt that is already gigantic at close to $80 billion, with only less than $20 billion in cash. Clearly, the fund is betting on oil recovering and thus BP being a value and perhaps also a high yield dividend play, but I've always been more attracted to the long term growth prospects of renewable energy stocks myself, so I don't think I'll be buying this one anytime soon. Moving on though to stock number 2, that's going to be Boeing, ticker symbol is BA, at over $700 million invested with an estimated share price of about $150 a share. And I'm sure you guys don't need any intro into what is essentially the world's largest aerospace company out there, servicing airlines and governments through commercial, travel, defense, and even space markets in over 150 different countries around the world. But because of tragic events with their 737M planes coupled with the huge drop in travel demand, Boeing saw 150 plane cancellations in March, and now it's been reported that another 108 cancellations took place in April, leaving Boeing in horrible shape with their lowest delivery numbers in over a decade and an enormous amount of debt that continues to climb. Speaking of which, their total debt is now 22 times their projected earnings, which analysts are estimating that that debt will take years to bring down to reasonable levels, and that means that there won't be a quick return to share buybacks and dividends anytime soon, which of course used to make Boeing a very popular stock but have now been cut altogether. As a result, the stock cratered this year and is still down about 60% year to date. Now, you would think that that would leave them with a super low valuation, but after recording a net loss last year coupled with low expectations this year, it still leaves them without a trailing PE ratio and a very high forward PE as well. Still, that market cap is unbelievably low right now at just $70 billion versus the over $200 billion it was sitting at last year, and that's leading to some investors taking the gamble on the stock since it does consistently perform very well during normal times. But I personally think that analysts are being too overly optimistic about this year and the next, with projected earnings growth of 23% and over 400% respectively. So I think I'll be staying out of this one myself, as I just feel that there are safer options out there, but I can definitely understand why others are buying the stock, given that it's probably too big to fail in the sense that the United States, as well as their many suppliers, rely so heavily on the success of Boeing. Okay, now moving on to stock number 3, that's going to be the very popular bank stock in Citigroup. Ticker symbol is C. At over $500 million position with an estimated cost of around $42 a share. And like I said, this is a bank here in the United States, and it's also a fairly large one, not quite as large as the big 3 by domestic deposits, which would be Bank of America, Chase, and Wells Fargo, but Citi is still pretty respectable there at 4th place, and they actually closed that gap a lot more when looking at assets as well. Now, they also tend to perform pretty well during normal times, doing close to $20 billion of net income last year alone, which is very impressive. And by the way, those giant profits also help them pay a very attractive dividend that currently yields about 4.5%. The problem, however, for bank stocks is that they depend on a strong economy in order to perform well. But of course, here in 2020, we have the exact opposite of that, with depression-like unemployment that will likely result in less people taking out loans for new purchases, and even when they do, it's probably because they're in desperate need of cash and might even be at risk of defaulting on those loans if they can't pay them back. Not to mention that any demand for loans in the first place is happening during a zero rate environment, which means less profits for banks on their interest rates. In fact, analysts are expecting Citi's earnings to plummet by over 60% this year before seeing a large recovery the year after. All that present danger, though, has crashed the banking sector, with Citigroup still down close to 45% year to date. On the bright side, that does leave them with an attractive valuation, as their trailing PE ratio currently sits in the 5-point range, which is considerably lower than it has been in the past. I happen to be more optimistic about bank stocks than most because I'm a long-term optimist about the US economy, but my favorite bank stock remains JP Morgan Chase, as I just personally feel that it's the best run of the bunch. But by the way, don't be surprised though if we see bank stocks actually cut their dividends if the economy continues to struggle like this. Okay, now next up here at stock number 4, that's going to be Facebook, and I actually love this purchase here, and it's for sure my favorite stock so far on the list. And this is also over $500 million position and is estimated in the $160 range for the share price, which is an amazing price as it currently trades well above the $200 per share mark. Now, unfortunately for us, the stock is a bit pricey right now that it's recovered with a trailing PE ratio of over 28, but on a 5-year PEG basis, it's only around 1.2, which is pretty reasonable for such a dominant company like this. And that's really what Facebook is all about, is that like long-term kind of future growth and optimism. Every year they seem to destroy numbers, doing close to $20 billion of profit last year alone on over $70 billion in sales. And even with advertising spend getting crushed this year because of our recession, which obviously heavily impacts Facebook as they're the second largest digital advertising company only behind Google, they are still expected to see double-digit revenue growth this year and then boost that growth rate by more than double the amount the year after as the economy starts to recover. Meanwhile, Facebook users continue to climb somehow, topping over 2.6 billion as of the last quarter. They have huge growth projects and platforms like Instagram, which I'm a big fan of, by the way, and they also have one of the absolute best balance sheets in the world that will ensure that they continue to invest in their future. Add it all up, and I think Facebook is a very strong foundational stock for the long term. I'm personally not interested enough at today's prices though, mostly because I already own plenty of foundational stocks myself, but I am definitely keeping a close eye on them and will likely buy on the next significant drop. Anyone who bought on those March lows though got an unbelievable price in my opinion. Okay, now moving on to stock number 5, that's going to be a hotel chain which have obviously been destroyed by the global health issue, and that is Marriott. Ticker symbol is MAR, at over $500 million as well, and close to a $75 share price. Now, any travelers out there are most likely very well familiarized with Marriott's various hotels. In fact, they have the third largest amount of hotel properties in the entire world, even ahead of giants like Hilton and Best Western. Of course, right now might not be the best time to have so many properties though, as many of them are forced to be practically empty given all the travel restrictions and stay-at-home orders. In fact, last month, Marriott said that as many as 25% of their hotels worldwide were completely closed, with close to 80% of their European hotels shut down as well, and that's still at an occupancy rate of around 10% or less, which is really bad to think about. As a result, the stock is still down over 40% year to date, although the stock has been climbing recently, probably due to newfound optimism that a V-shot will be released later this year and help world economies continue reopening with travel restrictions easing over time. But it's also likely due to the various moves and policy changes that Marriott has been doing themselves, like using hospital grade cleaning supplies and offering certain discounts and specials like 20% off their hotel gift cards that have little to no restrictions. Still, the company was forced to suspend their dividend, and while they are generally a solidly profitable company, the fact of the matter is that even as the world starts to reopen, we're still in a global recession right now, and that will likely mean less leisurely spending on things like travel, resulting in a revenue crash of almost 30% expected this year, with an earnings drop of almost 60% to go along with it. Analysts do seem to be optimistic about a sharp recovery the year after though, but I'd be cautious about those estimates. Overall, I think the road to recovery will be long and bumpy, and I just feel that the current valuation is not low enough to reflect all that uncertainty. So I think I'll be staying on the sidelines myself, even though I do think that they can eventually recover over the long term. Okay, and finishing up here, before we rapidly list off the rest of the stocks, coming in at stock number 6, that's going to be a stock that I actually own myself, which is of course Disney. Ticker symbol is DIS, at just slightly under $500 million with an estimated cost basis in the $90 range. And just like Facebook, I am totally on board with this purchase. In my opinion, Disney has always been a decent buy, anywhere around $100 or less, which of course they currently sit above that mark right now, although they are still technically down about 20% this year and sit near the midpoint of their 52-week range. Their crash this year though was definitely for good reason, as the global health issue forced them to temporarily close their theme parks, resulting in profits crashing by over 60% last quarter, which convinced them to cut their dividend and furlough over 100,000 employees to save as much cash as possible. Things are starting to look up for Disney though, as their Shanghai park has now reopened, and all the recent positivity surrounding a V-shot and economies reopening is leading to some optimism about the rest of their parks opening sometime soon. Still, they will definitely be at much lower capacity, and don't forget that Disney is also by far the market share leader of the US box office, which will also continue to struggle throughout this year until things finally start going back to normal, which I think will really start to ramp up next year. Long term though, Disney remains a compelling stock with incredible brands, growing streaming services that only got larger with the lockdown orders, with Disney Plus seeing explosive growth ever since launching at the end of last year, and of course a proven history of strong financial performance. The price is too high for me at this time given all their struggles and the fact that I already own a large position myself, but like I've said many times, I think anywhere around that $100 kind of mark or less, especially less, is a good price for the long term, just my opinion. Okay, so those were the six top largest stocks in the portfolio. Now let's just go ahead and wrap up the video with a quick rapid fire of the rest. And coming in at number 7, that's going to be Cisco, mostly a networking company that sells various routers and switches, but also has a good services business, including cybersecurity. And it's always been a stock that I enjoy tracking, but don't own myself. Number 8 is another bank in Bank of America, pretty well run bank, but like I've said before, I just prefer JP Morgan myself. Number 9 is Royal Dutch Shell, another oil stock. Not interested in those as I mentioned earlier, but I will just say that I actually always buy shell gas for my car. And then at number 10 is Suncor Energy, which I've honestly never really heard of them too much, but I believe that's another oil related stock, which I guess does make sense since oil stocks have taken such a big hit. And of course, Saudi Arabia is probably bullish on oil for obvious reasons that I think you guys can figure out. Number 11 is actually a stock that I do own in Carnival, which is the world leader in cruises, but my position is very tiny and I actually sold a lot of it recently to cash in some profits, which I'm going to be talking about further in my upcoming monthly update video. So make sure you guys keep an eye out for that video. It should be very soon, probably this week. But number 12 is going to be Live Nation, which is a company that sells tickets for live events like concerts. And obviously, the stock got destroyed this year because of that global health issue and all the restrictions in place. But a lot of people are talking about it because Mark Cuban is invested in it, but it's not really a stock that I track on a regular basis. Number 13 is Canadian Natural Resources, which is another oil and gas company, and you know my feelings on those. Number 14, we're down to a $200 million position now, and that is Total SA, which I've never heard of myself, but apparently it's another oil and gas company. And then the rest of these are all much smaller positions at less than $100 million each. And coming in at number 15, that is Union Pacific, known for their railroad and transportation business, but not a stock that has been exciting enough for me to look deeper into. Number 16 is Pfizer, which is in the news right now for their work on V-shots, but I'm not really experienced enough with biotechs to invest heavy into that sector. So the only one that I actually own myself is AbbVie, although I have been watching Johnson & Johnson more closely lately, and it is a stock that I hope to maybe one day own. Number 17 is Automatic Data Processing. I don't know much about them, but I think they offer like outsourcing and cloud-based services to businesses, which could be a big deal right now. And that does sound very interesting to me. So I may have to look deeper into that one in the future. And then number 18 is Berkshire Hathaway, obvious company there led by Warren Buffett, always a safe choice for long-term minded investors, but has never really been exciting enough to really catch my interest. Number 19 is Booking Holdings, another beaten down travel related stock that owns travel booking sites like booking.com, Kayak, and Priceline. And that one actually does sound pretty interesting to me, so I may have to research them a little bit more as well. And then number 20 is Qualcomm, which is a big 5G player, and that could actually be a good long-term bet. I actually kind of like them. Number 21 is IBM, a bit too much of a legacy player for me, but they could have some potential with hybrid cloud services. Number 22 is Starbucks, always a decent choice there. I think they'll survive this and do fine over the long term. Also a great dividend play as long as they don't have to cut it soon. And finally, number 23 at the end is Broadcom, which also complements Qualcomm with a lot of 5G potential for the long term. Okay, so I think that just about does it for the video. That was a lot of stocks to look through, but we got through them, and I hope you guys enjoyed the video. Let me know your thoughts down below. Are there any stocks that caught your attention? Any stocks that you already own? I would love to hear your thoughts, and I'll try to respond to as many comments as I can. Of course, I already shared all of my opinions on these stocks. So I'll just stop talking here and try to end the video. But thanks again for all the support. I hope you're all doing well out there, both health-wise and financially. And I will catch you guys in the next one. Take care. Bye-bye.